Hey, and welcome to a new video here on our video series. Today I want to talk about one of my favorite concepts, and it's the risk-reward ratio. I will introduce it, what it is, how you can measure and use it in your trading, and give you a good understanding of the basics of the reward to risk ratio. So first of all, as the name suggests, the ratio puts your reward on your trades in relationship to the risk you take on your trades. And so it tells you about the potential profitability and gives you a way to measure and analyze your trades. Obviously, there are two components when you build a ratio. It's the reward and the risk. And in trading, the risk is our distance between the entry and the stop loss. And on the other hand, the reward is the distance between our entry and our take profit, because this shows our potential reward on our trade. So this sounds all complicated, and let's take a look at our charts to see it's quite simple actually. So I always use TradingView for my trading, and TradingView has a very nice tool that allows you to measure the reward to risk ratio. So first you go here on your left menu and then here on the long positions. So let's assume for whatever reason we want to enter a buy trade here on the euro right now. Then after we select the tool in TradingView, we just click here. And then now you see that TradingView gives two boxes. The upper side of the box represents a potential target, and the lower one is a potential stop loss. So, and you can move them around. And then here you can see your reward to risk ratio. So as you can see, as you move your stop loss closer to your entry, the reward to risk ratio becomes larger, because now the ratio between reward and risk increases obviously. And the same was true if you set your target a little bit closer, then the reward to risk ratio becomes smaller. And so you can already analyze your potential profit. You can analyze your profit potential and your risk potential on your trades with this tool in TradingView. In the next video, we take a closer look at some of the advanced concepts of the reward to risk ratio, but here's the main thing how you would use the reward to risk ratio, and it is that you compare it or set in relationship to your win rate. So let's go through a few examples. So let's say you have a trade with a potential reward to risk ratio of 1:1, which means that your winners and your losses have the same size. Obviously, when you lose one trade with such statistics, then one winner and one loser cancel each other out. And as long as you have a win rate that is higher than 50%, then you will end up making money. And this is basic statistics. So if you have one winner and loser, they're the same size, then you need to win more than 1 out of 2 trades, and then you can end up making money. And for example, if you have a reward to risk ratio on your trade with 2:1, it means your winners are twice as large as your losses, and now you only need to win 1 of every 3 trades. So if you lose 2 trades and then you have a winner, this cancels each other out again. And this means that as long as your win rate is higher than 33%, you will end up making money. So this is very important to understand the connection between reward to risk ratio and required win rate, because it shows you that you don't need large winning trades and you don't need a high win rate. Everything in trading is based on statistics and probabilities, and even if you don't like math or you're not good at math, this is the only and the most important thing about probabilities and statistics that you have to master as a trader. You always have to understand how reward to risk ratio, the size of your winners and losers, impact your required win rate. And this is the basics and first principles of reward to risk ratio. In the next video, we take a closer look at more advanced features, and I will show you how you can use it with some practical examples.